Hello, people. This is Dr. Wang here recording. Today, we are going to cover a new chapter, chapter number 5, the market for foreign exchange. So, what is a foreign exchange market? Actually, that is the largest financial market exists in a global scale, and it's judged by trading volume. And the daily trading volume of exchange is around 3.73 trillion US dollars. That's a statistic in 2010. This is from the textbook. So if we have 250 trading days in a year, that's roughly over 800 trillion US dollars. So that's quite large. And many of this exchange trading is done by derivatives like options, futures, and currency swaps. London is the largest foreign exchange trading center, and we have a textbook exhibit I will show you later. But the situation is not the same for the U.S. You see, U.S. is not the same as the rest of the world. The U.S. exchange trading volume is not as large as the bond trading volume. There's the reason behind that. First of all, U.S. is not very active in foreign exchange trading compared to other countries because our US dollar is widely accepted as a currency in our international transactions. So we don't have to convert dollars to other currencies. And the second, US bond market is also very popular. The rest of the world treat the treasury bills, treasury bonds as risk-free assets, and they want to spend their money to buy the US bond. So that makes the US bond market more active than US exchange market. So you just need to know that. And London, again, is the largest world trading center for foreign exchange, and it accounts for 1/3 of the foreign exchange trade in the world. So if we take a closer look at the exchange trading volume, so in each day, roughly $4 trillion worth of currencies are being traded, and $1.5 trillion are in spot transactions. The rest would be in forwards, options, futures, and currency swaps. The rest here, from forwards to options, these three are considered derivatives. Derivative is a financial product whose value is deriving from the underlying assets. And in this case, the underlying assets is a foreign currency. The top 15 currency traded in the world, of course, US dollar is being top number 1, followed by euro, Japanese yen, British pound, Australian dollar, and so on. You see Hong Kong dollar is also very actively traded, even though Hong Kong dollar has a pegged exchange rate with US dollar. You see that's a fixed regime. Although China is the second largest economy in the world, you do not see Chinese yuan being very actively traded. That's because when we are engaged in trade with China, US dollar is the accepted currency. So you just pay the Chinese US dollars, that's it. You don't have to convert dollars to Chinese yuan to pay your Chinese partners. And also the trade of US dollars to Chinese yuan or yuan to US dollar are not actively done by the international traders. It's only possibly done by the People's Bank of China, which is the central bank of China. So that basically takes the Chinese yuan off this table. Here are some currency symbols for your information. You can take a look and see their abbreviations. Here is a chart coming from the Federal Reserve Bank of New York that basically tells us the daily trading pattern of a foreign exchange. So when Tokyo gets started, so that's 1 o'clock Greenwich time, that's 10 a.m. in Tokyo in the morning. And then the Asians are the only players at this time because when the Japanese are trading, Americans are sleeping. And then gradually the Europeans are coming out. Then you will see the exchange trading volume reached a peak. That's actually the highest peak over the day. That's because then this peak combines the trading of both Asians and Europeans. And then the Asian people are going out, and then it's lunchtime in London. The trading volume declined, and then after that, Americans stepped in and keep trading. So this second peak right here, it includes the trading from Americans and the Europeans. If the Europeans traded roughly the same in the morning and in the afternoon, then the comparison of these two peaks tell us what? It's telling us that the Asians are trading more than Americans in foreign exchange when the Europeans trading volume is flat over the day in our assumption. Okay, and then the Europeans are going out, only Americans are trading, and then the New Zealand people are coming in, and then the Americans are taking off, so it reached to the bottom for the whole day for the exchange trading. So when we look at the foreign exchange market, we can divide it into over-the-counter market. Over-the-counter market basically involve no physical trading floors. And there's also physical trading floors, but not for currency per se, but for currency derivatives. As I said, derivatives include options, futures, forward swaps, and so on. Where is the largest trading floor for currency derivatives in the world? It's right here in Chicago. It's in downtown. Chicago Mercantile Exchange. That's what the floor is called. And the over-the-counter market here usually involves spot and forward trading, and it's usually a bilateral agreement between two parties, a multinational corporation and a international bank. And that brings to the foreign exchange market participants. So there are a lot of international banks who host money, of course, and a different kind of money. So they have a lot of different sorts of currencies to engage in the exchange. You also have the bank customers, mostly the foreign international corporations, the MNCs, and also money managers who invest overseas, and also private speculators who try to divert their assets globally. There are also non-bank traders, mutual funds, insurance companies, investment bank. They want to hold certain currencies as their assets if they believe the assets will increase its value or the currency they hold will appreciate in the future. They may also take the opposite position by short selling the currency which they believe is going to depreciate. There are also brokers for foreign exchange, and of course the central banks are playing a very big role in the exchange market, especially the central banks from developing countries. For the developed countries like the United States, like UK, the central bank usually doesn't touch the foreign exchange market. They only affect the exchange rate by their monetary policies. Okay, so here I want to mention the difference between dealers and brokers. So what's the difference here? Brokers basically do not hold inventory of those assets, of those currencies, but the dealers do hold assets. A good analogy would be a car dealer. You know, we don't call them car brokers because the car dealers has to have cars in their garage, in their parking lot in order to make sales. But for brokers, they don't hold inventories. What are the broker examples? Like Match.com, right? They just match the single man and single women together, and they don't hold them as inventory. Okay, and the brokers in the financial world basically just match the buyers and the sellers of certain products to facilitate the trade. Here is the top 10 currency traders. You will see Deutsche Bank from Germany is on the top list, followed by Citigroup, which has businesses in over 100 countries in the world, and then Barclays from UK, UBS from Switzerland, HSBC from UK. HSBC stands for Hong Kong and Shanghai Banking Corporation. It's a very much an Asian name, but actually it's a UK company. And then you will see other American banks and European banks are being the top players of currency exchange. And altogether, their market share is over 3/4 of the global trading. The foreign exchange market can be divided into client market and an interbank market. The client market basically is a retail market which only accounts for 14% of the volume. So it's usually the international banks serve the customers. Like if you are going to Budapest for a vacation, then you will need to go to your own bank and get some Hungarian forint. So that is considered a client market trading. Interbank trading is a wholesale market. It's a different ball of game. It's accounting for 86% of the volume in the world. It's done by 100 to 200 banks in the world who are ready to make the market. They will do the trades to satisfy the seller's demand and the buyer's demand. The non-bank dealers takes 47% of interbank trading. And also there's a network of correspondent banking relationships. So what is the network? The network is like this. If you are wiring some money from the US to your relatives in Italy, you will need their bank's SWIFT code. A SWIFT code is the ID number of a bank in the global banking system. Okay. So the SWIFT stands for Society for Worldwide Interbank Financial Telecommunications. So if you want to wire money to other people's bank account, you need to have their SWIFT code. And definitely the recipient of your money will need to know your bank's SWIFT code to make this transaction. There's also a system called CHIPS, which is a clearinghouse interbank payment system. 95% of the clearinghouse transactions is dollar transactions. So the Federal Reserve Bank, which is the regulator of US dollars, has to be involved. So what is a clearinghouse anyways? If I draw a picture here, let's see, we have several parties, party A, party B, party C, and party D, and they just trade with each other, okay? Dollar to yen, euro to dollar, and pound to euro, and yen to pound. Okay, this is a system without any clearinghouse. So they just do bilateral trading, and you can see it's very difficult to find the right partner. You have to sniff around and find the one with the right currency, with the correct amount at the right time. So here, there's no clearinghouse. So what will be the situation when there is a clearinghouse? You will have the clearinghouse serving as a hub in the center. Then you have all the other parties. They don't have to deal with each other. They just need to deal with the clearinghouse, and that's it. Okay, you can see there's not so many bilateral relationship among these four parties. Each of them just need to trade with the clearinghouse for the currencies they want. And that facilitates the trading in the exchange market. You also have this ICO system, which stands for Exchange Clearinghouse Limited. That's the first global clearinghouse for settling interbank foreign exchange transactions. So this terminology is something you need to keep in mind once you graduate and work in a bank, especially the international department of the bank. And here, I want to focus more on the spot market transactions. Spot market is for immediate transactions, but the futures market, forward market are for the delivery, for the transactions which will occur in the future, a month from now, or 3 months or 6 months from now. And the spot market, in stark contrast, is the transactions happening today. Okay, so in the interbank market, which is the wholesale market, the trade is quite standardized. It's in the volume of 10 million US dollars and multiples. So if a multinational corporation, say like the Boeing Corporation, wants to get some British pound, they have to trade US dollars to British pound, either at a $10 million level, or $20 million, or $30 million, or even $100 million. And here is a spot market quotations. It's just the same quotations we learned before, but you should know that there's a direct quote, there's also indirect quote. You have these four currencies in the market. Canadian dollar here as an example, if it is in US dollars, this would be a direct quote. That's 0.9984 US dollars per Canadian dollar. And this 1.0016 is the reciprocal of that number, and that is indirect quote. That means 1.0016 Canadian dollar would be equivalent to 1 unit of a US dollar. Okay, the direct quotes and indirect quotes can also be called a American term, okay, or our home term, and a European term. At that time, the only foreigners who are dealing with us in the international financial markets are Europeans, not from China, not from Japan. We're talking about the financial markets 100 years ago. So the foreigners are just Europeans at that time, and we just keep using the term until now. And if I read this, 1 British pound is equivalent to 1.25 US dollars. So this is an American term. So it's 1 unit of a foreign currency in the amount of US dollars. The European terms would be the reciprocal of that number. If you take the reciprocal, it will be 0.08. And it is 0.08 British pound per US dollar. If a Brit wants to buy a US dollar with their own currency, they would say, okay, it's going to cost 0.8 of our own currency, which is a pound, to buy 1 US dollar. And here are some other illustration. In American terms, we say a Japanese yen is worth a penny. That basically is telling us 0.01 US dollar is equivalent to 1 Japanese yen. And in European terms, or the indirect quote, is 100 Japanese yen per US dollar. So if you look at the European terms, then it's the US dollar being on the right-hand side of the fraction line. And if you look at the American terms or direct quotes, it's the foreign currency being on the right-hand side of the fraction line. Just keep that in mind. Now we're talking about bid-ask spread. Bid-ask spread is the transaction cost for us to buy and sell a foreign currency. It is also the revenue made by the traders to satisfy our need. If you go to a bank, let's say if you go to a bank and you want to trade for some euros, and the bank would offer you 2 prices, one is ask and another is bid. You just keep in mind, ask is always about buying things, okay? And bid is always about selling things, okay? And then the bank would offer you 2 prices. Let's say one is $1.2 per euro and another is $1.1 per euro. The third thing you have to remember is ask is always greater than bid, like 1.2 is greater than 1.1. Okay, so no matter you are using direct quote or indirect quote, American terms or European terms, okay, ask is always greater than bid. Okay, so what does that mean? So if I want to buy some euros right away, let's say my goal is to buy 1,000 euros. And then I will go for this ask price. Okay, I will go for this ask price because ask price is about buying. Then how much dollar do I get? Then I will get 1,200 US dollars. And if I want to sell 1,000 euros, okay, then I will need to go with this price for selling. Then I will get 1,100 US dollars. Since if I'm buying things, then this is something I need to pay. I need to pay $1,200 for 1,000 euros. And if I'm selling it, that means I need to spend 1,000 euros and get $1,100. Okay? If you keep doing this, then you will lose money, of course, because you keep paying more than what you receive. Okay, that's how it works. That's how the bank make money, by doing the trade with you. When you're doing this trade, you pay more than you will receive, and the difference is called a bid-ask spread. And this bid-ask spread is the difference between these two. That's $0.01 per euro. and you can split it in half. That's a $0.05 per euro. So per transaction, either a buy order or sell order, a bank can make a 5 cents dollar per euro. Okay, so that's a very simple example. If you go to the exchange market, things will be more complicated because there's not just one bank facilitate the trade. There could be many banks and many dealers or even brokers to do the trade. So you will have a lot of ask prices, and you will have a lot of bid prices. And the ask is the buyer's market. You are the buyer, and the dealers are actually selling the pounds or euros to you. Okay, think about this. Ask basically means you buy things. Okay, just like above, when it's ask, that means you are buying it. Okay, and if it's a bid, then that means you are selling things. You sell. Okay, and if you buy, you pay more. If you sell, you get less. That's how it works. Otherwise, the dealers do not make money. And in the more sophisticated financial system, you could have different banks who do the trade with you. We have 3 banks, for example, and we have 3 banks here for you to sell your currencies to. All right, and they each come with a different price, because not everybody want to offer the same price. Each of them have their own level of a price depending on how well they operate and how much money they want to make. Let's see, for pound, the one bank here is $1.2 per pound, and the second bank is $1.3 per pound, and then the third bank is 1.4. And right here for the bid, ask is always greater than the bid, so the bid here is 1.1, 1.0, and 0.09. Okay, so what's the point here? Each of the bank have a certain level of capacity. So for this ask 1 bank, they have a 100 pound at hand, and for ask 2 bank, they have a 50 pounds at hand, and then for the third bank on the ask side, from whom you can buy from, they have a 200 pound. Alrighty, and for these 3 banks to whom you can sell your pounds to, they have different inventories, of course, 200 pounds, 200 pounds, and 100 pounds. Okay, so if you want to trade, let's say you want to buy pound. If you want to buy pound, then you want to pay less dollars, right? You want to pay as less as you want. Then you should go for the first price. If you only trade for, say, 50 pounds, okay, then does this bank have enough pounds for you to trade? Yes, it does. So you will just need to get half of bank 1's inventory, and then pay for 50 pounds times $1.2 per pound. This is $60 US. Okay, but what about if you want to buy, in another case, 300 pounds? Okay, 300 pounds. Then you will still, let's say this is isolated from this case. This case is it did not happen. Okay, this did not happen. Let's say instead of buying 50 pounds, you are buying 300 pounds, and you will check the market. 300 pounds exceed this guy's inventory. It also exceed this guy and this guy, okay? Bank 1 and bank 2. And then bank 3 would have some extras to satisfy your demand, okay? So you will be dealing with 3 banks in this trade. So that is 100 pound from bank 1 at $1.2 plus 50 pounds from the second bank at $1.3 plus, what's the rest? The third bank has a 200 pounds, but are you going to buy all the 200 pounds from that bank? Not really. You are buying whatever you need to satisfy 300. So what else? How much else do you need to buy? 300 minus 100 minus 50, that's going to give you another 150 pounds left. So you will buy 150 pounds instead of not 200 pounds from bank 3 and to the price of a 1.4. And then you will do the calculation. That's 120, and this is 65, and this is 210. All right. So eventually, after dealing with 3 banks, you are paying $395 US. Okay. So that's how we play the game. Let me erase this. Let's say instead of buying, you are selling. Let's say if you want to sell 250 pounds, okay? Definitely when you sell things, they wouldn't let you to sell at 1.4, 1.3. If you sell things, you will go with the lower end because you are always at the bad end of the deal if you're doing with the trade with the banks. So if you sell it, then you will look at the best price first. The best price is this one because that's the highest bid you can sell at. But does that satisfy your need? Not really. You need to sell 250, but this one only have 200. So basically, you will get all the inventories from the first banker at $1.1 per pound, and then you still need to sell another 50 pounds, and that's gonna coming from the second banker's inventory at $1.0 per pound. So after this trade, the second banker's inventory will be reduced by 50, and the first banker's inventory will be reduced by 200, and this one is gone, and that's the only price, or the second best price exists in the market. Sorry, the second best price just becomes the best price in the market. Okay, so how much money do you get? That's $220, and this is $50. So altogether, you get $270. All right. So if we do a more complicated case, if you want to sell all 500 pounds, okay, all 500 pounds. So let's say this case is isolated from the previous one. They have nothing overlap. So if you go with the second one, then the first inventory would be gone, the second one would be gone, then the last one would be gone, and that just happened to make the 500 pounds you want to sell. So that will be 200 pounds times 1.1 from the first banker, and then 200 pounds times 1.0 from the second banker, and then 100 times 0.9 from the third banker. So you will do the math here. $510 you would get. Okay, so that's how the bid and ask work in a single bank transaction, and also in a market system, which consists of multiple bankers on the buying side and multiple bankers on the selling side. Alrighty. There are some determinants for the bid-ask spread. So as you can see, the larger the bid-ask spread, that means you are losing more money by paying the bankers or the dealers to do the exchange, or the bankers and dealers are making more money out of you. If you have a bid-ask spread for euro, bid is $1.1 per euro, the ask is $1.2 per euro, okay? And suddenly it enlarges to $1.4 for the ask and $0.08 for the euro. So this spread is smaller, and this spread is larger. So what makes the spread larger? At different time period or for different currencies, the spread in percentage may be different. And the reason behind that is the inventory cost for holding this foreign exchange. As I mentioned earlier, these are dealers, and the dealers hold inventory. So what is their inventory? Their inventory is cash. Okay, it's cash in pounds, cash in yen, and in euros. And what's the cost for holding cash? Let's say if you don't hold the cash, you're gonna put them in a bank account and make you some interest, right? But instead making interest, you are putting them in a cash, make them ready to trade, so you're not getting the interest. So that is the inventory cost. So the inventory cost for the dealers basically is the opportunity cost of not getting interest. The higher the interest of the currency, the more opportunity cost they have to bear, then they would charge you more spread. And also risk is another factor. In the world of finance, we are always on a theme of a higher risk, higher return. If you're dealing with a very small currency, soft currency, and also dangerous currency, then the bank who facilitate the trade have to bear all the risk to make you happy when you when you need to buy or sell. Then they have to get compensated for the risk they are having. So they would charge you higher bid-ask spread, which would in turn to be more revenue for them. And there's also liquidity concerns. Some currencies are more liquid, easy to transact, easy to sell, and some currencies are not liquid. We call them illiquid. So these are currencies that are not easy to transact. If we come to this idea of a liquidity, then it basically is the price change over the quantity change. All right. So let's say if the quantity change by a lot of let's say if the quantity increase, then what happened to the price? The price would increase. Let's say if you keep buying, and if you buy more and more and more, and then what happened to the price? The price would get higher and higher and higher. So that's the regular situation, because the demand goes up, then the price would go up. Okay, and if you keep selling, it's the opposite. When you sell, you supply. When supply goes up, then the price would go down. So if you keep selling more and more, the price would go down and down. So that's how the price would change in reaction to the trading volumes. A high liquid currency would be like this. Okay, let's say this is a high liquid. That means when the change by a lot, okay, either go up a lot or go down a lot, the price doesn't quite have much changes. Okay, it doesn't have quite much changes. The price stays stable. Even though there are a lot of people buying it, the price doesn't go up, so that's good. Or a lot of people are selling it, the price doesn't go down, so that's good for new buyers or for new sellers. So this is a high liquid asset, so that's good. And for illiquid assets, okay, or currency, likewise, if the quantity change by just a small amount or increase or decrease, you buy or sell, then the price would change by a large amount. Okay, just a flip of finger would make the price change a lot. So you can say the price has very high sensitivity to the trading volume. And this is not good, because if you are a buyer, you just keep buying more and more, and the price will get higher and higher. You end up paying more and more price. As the example I showed you earlier, like right here, if you are a buyer, then you keep buying. The first price you pay is 1.2, then you buy more, you pay 1.3, then you buy more, you pay 1.4. You pay more and more prices, which make you less and less happy. So that's the disadvantage of illiquidity. Likewise for the selling, if you sell it, you will get sell small amount, you will get this high price. But if you keep selling more, you will get a lower and lower price. Then you are not happy. Okay, so that's why we don't want illiquid assets. Okay, so this is bad. I have spent a lot of time to explain the definition of illiquidity. So it's basically it's a large price change in response to small trading volume. And if the dealers or the bankers are providing the trades of such illiquid assets like Hungarian forint, like Zimbabwe dollars or Egyptian pound, then these currencies are very illiquid. That means the price would change unfavorably when the trading volume increase, and that kind of posed so they just don't want to hold bad currencies, so to speak. Okay, the bankers, the dealers don't want to hold bad currencies. If they want to provide that service, they would charge you more money. Okay, so bid-ask spread would be a quiz in your would be an upcoming quiz. So just be careful with that. So we'll be asked the definition of liquidity and illiquidity, and also what would happen if you are buying certain amount of a currency or selling certain amount of currency when you are looking at the askers and also the bid bankers.